Initial jobless claims coming in just as expected. Join us right now to talk about the data, the markets, the latest Fed commentary, maybe what we're going to hear out of Jackson Hole. Jeremy Siegel, professor emeritus of finance at the University of Pennsylvania's Wharton School of Business, also chief economist at Wisdom Tree. Good morning to you, sir.
Good morning.
So
Andrew.
what do you think of the jobless claims number? What do you think of this sort of larger, revision going back a year? Does it matter?
Let me try to explain where I have trouble with Fed policy. The Fed has stated that its long-term Fed funds rate is 2.8% when risks are balanced. Now, taking a look ahead 6 months, if I were to ask you, what's more likely, a flare-up of inflation or a weakening job market? Now, we got decent numbers certainly today, but between those two, I say it's balanced, maybe even more towards a weakening job market. Well, then why are we at the most restrictive monetary policy in over half a century if we have almost a risk-balanced look going forward? Now, a lot of people came back to me when I was, really agitated a couple of weeks ago. They said,
and you wanted 50 basis points, and then you switched gears.
I wanted 50 basis. They said, oh, it's not 2.8%. They put that down, but it's really much higher. The economy's doing well. It's 5.3 right now. Economy's doing pretty well. Maybe that neutral rate is 4.8%. So they only need really a couple of cuts to get to that particular level. Well, if the neutral rate for Fed funds is 4.8 instead of 5.3, then why is the 10-year bond at 3.8? If you go through history, normally the 10-year bond is about 100 or more basis point above the neutral Fed funds rate, which would put it at 5.8. Wow, not at 3.8.
Right.
Something is sort of out of kilter here.
So what's the answer then? Meaning, what would you do?
I think the Fed
if you were in
is just
Jackson Hole
moving way
right
too
now.
slow. I think they're taking on risks they don't have to take. If they would move it down faster, and I know that Steve said it's 25, 50, 25. I mean, if they go 50, 50, right. If they get back down towards that 3 grade, I actually think it's 3.5, a little bit higher than what they said. But the faster they get down, the lower the probability that they're going to have a recession and a significant slowdown in the economy. And that's basically, I would like them to explain what, with risks nearly balanced, why are they twice as high as they should be?
Okay, let me ask you a different question then. Given what you know, given what you want them to do and what you think that they may do, how are you thinking about buying or not equities in this market?
I think equities are, they're basically you're at 21 times forward earnings. S&P is within 1% of an all-time high. 21, I've often said 20 is equilibrium, so it's a little high. Now, if you take out, the Mag 7, you're at 17, 18. They look more attractive. I don't see the small and value stocks moving until the Fed moves. And maybe more convincingly, I think that Chair Powell is definitely going to open up a cut tomorrow in his speech. He will not specify how much it'll be. They still have 4 weeks of data coming. I certainly hope it's larger rather than smaller to get back to where I think that neutral rate is.
And then, Professor, we keep asking the same question, in part because the DNC convention just happened or is happening right now, and Republicans had their convention a couple of weeks ago. Do you think that the market is saying anything about which way the White House is going to go in November?
Well, I think that if the Dems get all three branches of the government, presidency, House, and Senate, then it's more likely that Senator Harris's tax plan, and we all know that all taxes need to be renegotiated on December 31st of 2025. Many of them are likely to be implemented. if the Republicans can hold either the House or more likely the Senate, and it looks like that could be very, very close, then basically, Harris's plans, I wouldn't say are DOA, but they're much less likely. The government still needs to renegotiate everything at the end of next year. The composition of the Congress, as well as the presidency, is really important. I don't think the market is yet focused on a 28% potential corporate tax rate and some of the other capital taxes that Harris is proposing.